Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, this time last week we were in our Grinch-like delight, wondering whether or not the S&P 500 option structure that you had might actually close in the money, but it doesn't look as if that's going to be the case.
No, it's not looking like that anymore. Last week when we spoke, and you can see the analysis here again, we looked at that and we said, well, the S&P 500 was beginning to break below that upward trend that had been intact since the beginning of this year. And it was below the 50-day moving average at that stage and appeared to be battling at the underside of the 50-day moving average. And I said at that stage it looked like it possibly could have another leg to the downside to go towards that 2400 support zone. But alas, that was not the case. It did break up through the 50-day moving average and has pushed on higher. So as things stand now, given that our option structure pays out, well, it won't pay out, but it expires on Friday next week, the 15th of September, it's looking unlikely that we'll end in the money, unless something drastic happens that takes the S&P 500 below 2430 by then. It's looking unlikely at this stage. But look, that is only where the S&P futures we're trading today. It's about 30 points, 35 points away, which is not a lot. It's 1.5% away. So for the market to move lower by 1.5% or more by this time next Friday, or by next Friday, it's possible, but it's looking unlikely, I think.
Okay. And then what about the local market? Because you know, you have now two positions against the top 40, and I guess we'll start with the option structure, which could end in the money, but also unless there is some sort of catastrophic collapse, unlikely.
Yeah.
And so in fact, it couldn't end in the money, could it?
It's looking unlikely as well. So where we sit at the moment, there's your chart of the top 40 future, which is what we focus on because the futures, the options that we've traded are options over this futures contract. You can see at the moment, the last 5 or 6 days have seen the market tracking a range between 49,400 up to 50,000. Those are your range boundaries. And we're waiting for the product to move one way or the other, either to break above 50,000, in which case it's likely to really squeeze the shorts and push on to new highs, or alternatively, if it does break to the downside below 49,400 and move lower from there, then I think there's a possibility that we could see 49,000 and maybe even a little bit lower. The futures closeout for this quarter is on the 21st of September, so that's still 2.5 weeks away from now. And we would need the futures contract to be below 48,000 in order for that for that option structure to move into the money. It's looking rather unlikely at the moment, which implies that we'll probably lose our premium of 2,300 Rand there, which is not the end of the world. What is rather frustrating, however, is that we were nicely in the money back in June. But of course, the way these options trade, that's pretty.
Well, don't count your options before the expiry date.
There we basically go, 100%. Yeah, exactly. You need we would need it ideally to settle in that sweet spot at expiry, which just doesn't look like it's going to do. Obviously, you can trade around these things, which we did do a little bit successfully back in June and July, but we probably could have made more money trading around it had I not had sort of a somewhat more bearish bias, really.
Yeah. Well, I mean, talking about that bearish bias, you actually, was it last week that you put on those all-me, the trade on the top 40, against the top 40?
Yes, that's right. It was last week, and this is the chart. Now, this is a 1-hour chart of the top 40 futures index, which is what we trade here. Remember, the all-me future is effectively like a mini contract. It's your typical all-Z future is 10 Rand per point, and all-me future is 1 Rand per point. So it's a tenth of the size. And what we did last week, we identified a head and shoulders pattern that you can see clearly indicated over there, and it broke down below the neckline of that head and shoulder structure. It gapped lower and then retested the underside of the neckline. So I went short 3 all-me futures at 49,725. The stop loss 50,100, and I'm looking for a move down to 49,000 here. So, as it stands right now, we're still in the trade. And if you look at this pattern over here, it looks like a large descending triangle that's evident over there. If the market starts to break down below 49,500, then I think then the game is on for it to move lower and possibly to move down to 49,000 where there's a gap in the chart.
I mean, are you waiting perhaps for a catalyst? Because, and maybe just remind us why you entered the trades in the first place, Garth?
Well, we entered it because of the fact that it was breaking down below the bottom of that neckline of that head and shoulders pattern, which does project to the downside. Yeah. In addition to which, on the daily chart, there's negative divergence which suggests that a pullback is coming, etc., etc. And we will talk about that a little bit more just now when we look at another option structure that we're entering for this quarter. But at the moment, it's looking fine. I mean, if it starts to break down below 49,500 convincingly, then I think we're on our way probably to go down to 49,000, and then we would look quite good on this trade. As it sits at the moment, we are in the money slightly on it.
Yeah, and this doesn't have a time expiry, does it? So you can...
No, it does. This one expires with the September futures close out on the 21st of September. But remember, we could always roll it over if we needed to. But my expectation is that we should have our result before then. So we'll be out of the trade one way or the other before the futures expiry.
Okay. Right. Before we talk about this week's trade, let's go to a position that you've actually now closed out, and it seems to have done what you wanted it.
Yes, that's right. This is this long trade on clicks, which we did a couple of weeks back, and it's worked out quite nicely for us. What I identified at the time was the fact that this upward trend that goes back to December last year is still very much intact. You can see each time the stock has pulled back to that uptrend line, it's found support and buyers have come in and pushed the price higher. In early August, we went long of 600 CFDs at a price of 143 Rand 60, looking for a move up to 150 Rand. Now that has happened. It got to 150 Rand the day before yesterday. And so we sold at that level in accordance with our strategy. And that allowed us to bank a profit of nearly 3,500 Rand, which is quite a nice healthy relief given that we've had a tough couple of months.
Yeah, so some runs on the board to use your cricketing analogy.
Certainly, it helps, yeah.
Okay. All right, so Garth, that was a long position. Now, you know, I've been talking about this the last couple of weeks about how a lot of the positions that you've entered into have been somewhat bearish. Now, you could argue that this is a bearish sort of strategy or structure that you're setting up for, I suppose, the last quarter of the year, but not necessarily, because so perhaps just talk us through the thinking behind this latest put spread option.
Yes, okay, so it's another put spread structure, this time out to December. Regular viewers will know that I tend to do one of these every quarter. And I like doing it because I like having that downside participation in the event that the market does pull back, but also knowing that it's effectively like having a short position, one without, you know, with limited risk. So if the market really rallies up hard, it doesn't matter. We know what we stand to lose. And that is, for me, a nice way to play the market on the short side if you are of the view that you could get a pullback at some stage. Now, going into this quarter now, do keep in mind seasonally September and into October is generally quite a weak time of the year in equity markets. So I won't be too surprised if we do see some sort of a pullback in the next couple of weeks, maybe to month and a half. And to take advantage of that, but also to take advantage of any weakness that we might then see, which potentially lines up a year-end rally, I've done an option structure this week, which basically buys us the insurance against a market pullback. But keep in mind, I'm going to do this with the view that I'd like to probably buy against it later on in the quarter if we see weakness in the market. So if we have a look at the chart and go through the whole thing, there's a top 40 chart. This is now the index itself, the top 40 spot index. What's quite interesting here is this negative divergence that you can see illustrated there on the stochastic versus the price. And that is where you get your stochastic oscillator making a lower high, yet the price is making a higher high. And that's really just an indication that the upward momentum is beginning to slow down, and it very often precedes a pullback. And if we were to see a pullback, the biggest obvious support area is that 48,000 support that I've earmarked on the chart over there. So what I've done is another one of these put spread structures, and I know these things are complicated, but it's important to try and learn how to do these because it's something I've done for a number of years now, and actually most of the time done it reasonably successfully. Sometimes these structures expire worthless, like the ones we spoke about earlier in the show. But you know, when they work, they can work beautifully. And that's why I always like to have it on. They give very, very good risk to reward ratios as well. So over here, we've got a chart set up. Along the bottom axis there, you've got the levels on the top 40. And then on the left-hand axis, you've got your profit and loss. Obviously, zero where the big black line is, and then a positive and a negative above and below that. Now, the first part of the structures, I've gone long of one put option on the top 40 with a strike of 49,500. Keep in mind, every 1 point here represents 10 Rand. So that's effectively a 495,000 Rand short position that I've bought here. And I've paid 11,000 Rand for that. It's quite a lot of money to pay for a option structure, given that this thing will make us money all the way down to zero, and the market's not going to go to zero, so why buy all of that participation? Let's sell away some of that in order to try and recoup some of the premium that we pay out. So in order to do that, I've gone and I've then sold short another put option with a strike of 48,000. For that, I receive a premium of 6,132 Rand. That's what I earn. And against that, I've then also sold another further out the money put option with a strike of 46,500, and there I received 3,395 Rand. So you can see how the premiums begin to offset each other. You've got 11,000 Rand paid away, 6,000 Rand earned, and nearly 3,400 Rand earned, and it kind of helps to offset the cost of that put. Now if I overlay all of these against one another, then you get that line, which is the thick grey line over there. And that is the overall payoff. If I actually tidy it all up a bit, that's what your overall payoff of this structure now looks like. So above 49,500, we pay away 1,549 Rand.
Okay.
It's 1.5% of the value of our account.
Yeah.
It's very
Pretty
small.
cheap.
Pretty cheap. We can make a maximum of 13,451 Rand between 46,500 and up to 48,000. And the whole structure is profitable between a level of 45,000 on the far left-hand side there, up to 49,500. So it gives us a fairly broad, profitable zone that we can participate in the event of a pullback. Now, if I overlay that payoff profile onto the chart of the top 40 again, here you can see it. So there is our top 40 graph. And on the right-hand side, you can see the payoff profile of this put spread option structure. Notice that above 49,500, our losses are limited to 1,549 Rand. We cannot lose more than that. If the market begins to pull back below 49,500, we then start to make money on the structure. At 48,000, we make our maximum profit on it. Now, I mentioned earlier that I would use this as an insurance policy to buy against in the event that we do see a pullback into the September, October time now. So that's what I'll be doing. I'll keep an eye on this, watch it. If the market pulls back into our sweet spot zone there, which I suspect it might well do, then I would probably use that as an opportunity then to actually go long the market, knowing that I've got this in the background providing me with insurance protection.
I mean, the timing though, I mean, is that, you know, it's not necessarily optimal if the kind of the seasonal weakness in the market is September, October, and this expires in December. Yeah. So you kind of almost, if this is going to work, you almost have to hope that the market's going to be where, you know, 48,000, so a couple of thousand points away.
But do keep in mind that if I trade around it, then I can effectively mitigate some of that risk.
Okay.
I mean, what would be ideal is if we had options expiries every month, but we don't. And overseas they have that. In fact, in the developed markets like the S&P 500, there's an options expiry every week. But we're not nearly as advanced as those overseas markets. So we only have these futures expiries every quarter, which means that when you do an option structure like this, you've got to do it out to the nearest quarterly expiry, which in this case for us is the December futures closeout.
And as you say, it's not you're not outright bearish at all. This is just insurance.
Yeah, that's right. I'm not outright bearish. I mean, I think we could see a pullback here. I'm quite confident of that actually, but I'm not thinking that we're going to be going all the way down into that sweet spot by the time December rolls around. I won't be too surprised if we see a pullback now and then a strong rally into the end of the year. And that's what I would want to participate in. But I'd be happier doing that knowing that I've got insurance in the background, which we created here.
Okay, all right. So that's the last quarter, I suppose, of the year. Garth, what does the portfolio look like, given that there's been a fair amount of activity? Yeah,
so here's our South African portfolio. So you can see there is quite a bit happening over here. We've still got the September put spread open, our clicks position, which we've made a profit of nearly 3,500 Rand there. Our ALMI futures are in the money for us, and then we've got this December put spread structure, which we've just discussed now. And then our offshore portfolio is a little bit better off this week. Our long position in Unilever has started to work out quite nicely and is trading up north of £45 today. So we are
and 46 is the target, isn't it?
46 is the target there, that's right. So we're making some profit on that Unilever trade.
Okay, Garth, we have to leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.